Afternoon and welcome to Value Line's webinar. Today's presentation is our 2017 Economic and Stock Market Forecast. This is brought to you from Value Line's Institutional Services Department, and I am your host today. My name is Jason Wiseberg. I am the Executive Vice President of Sales here at Value Line, and we are going to go over, again, our outlook for the year ahead. Before we begin, just a couple housekeeping items I want to attend to. First, for those attending who may be new to Value Line, just to give you a quick overview of the company. We've been helping investors make better informed decisions for about 85 years. We just celebrated our 85th year in business. We're based in Midtown Manhattan, and our analysts cover approximately 3,500 companies, as well as produce research on our mutual funds, ETFs, options, and convertibles research. We also provide model portfolios. We have about 50 analysts working in tandem with our time-tested proprietary ranking service, and our goal is to produce the highest quality research possible for our subscribers. Today's webinar is really geared to the professional audience. Our institutional department covers two types of customers. That's the professional space, and then the academic and municipal libraries would also fall on the institutional ranking. Again, today we're going to focus on our special webinar for those of our professional and prospective customers. So when we begin, just a few housekeeping items I want to note. The webinar is scheduled to run about 20 minutes or so. If you'd like to ask a question, we ask that you submit it via the Q&A window on the WebEx platform. All the questions will be addressed at the conclusion of the presentation. If time doesn't permit me to get to your question, we'll definitely follow up with an email to your answer at the conclusion of the webinar or shortly first thing tomorrow morning. We'll also provide some contact information at the conclusion of the webinar to tell you how to reach out to us at any time to ask a question on this or any other topic that you may have. One last note before we begin, WebEx platform has been a little sketchy when it comes to audio. So at any time during the presentation, if you hear silence, that means the audio on my end has cut out. Just bear with me a couple seconds and I will reconnect it, but I'm hoping that will not be the case this time. You'll know when the webinar is over. I will tell you the conclusion of it. So if you don't hear that and just hear some silence, you know the audio cut out on my end, and I apologize in advance if that should happen. One more special bonus that nobody really knew about was coming today on the webinar. At the conclusion of the presentation, we're going to talk about a special stock recommendation that our research department has put together. So after we discuss the overall economic and stock market forecast, we're going to treat you to a specific stock recommendation that we believe might be of something to take a look at. With that said, on your screen, I'm going to jump from our Value Line Pro site over to paid product. And right now, you can see we're on the dashboard. As I go through the presentation, you'll see on your screen different areas of the service that I'll highlight to coincide with the research. And for those of you who are current subscribers, how you could use us and those prospective subscribers, just to give you a little taste of what you would get with us. So let's dive right into it now. The following commentary was prepared by Harvey Katz, our chief economist, and Ian Gendler, our director of research here at Value Line. As we go through the discussion, I'm going to demonstrate, as I mentioned, some of the professional service platform to help put the forecast in perspective. So the commentary is also available for download for our paid subscribers, but you can also contact us via email the copy of the commentary as well. So on that note, a year ago, we were looking back on the 2015 equity market, which, like its predecessor, had been relatively unimposing with regard to the Dow Jones Industrial Average and the smaller indexes. What's more, entering the final weeks of 2016, if we might be closing out another year of underwhelming results. Then election intervened, and thoughts of a listless 2016 faded away. Recap, following a stellar 2013 for Wall Street and a rather ordinary 2014 and 2015, This ended year saw plenty of back and forth action with a notable setback early in the 12-month cycle. A stiff and uneven recovery during the middle quarters and strikingly fast close, buoyed by mostly unrelenting gains in the wake of the surprise election of Donald J. Trump. Have taken well to his pending ascension to the presidency on the expectation that it will mean substantial infrastructure spending, a more business-friendly tax code, and a wave of deregulation. This will tell just how much of this agenda will get enacted by Congress that often has emphasized cost containment in recent years. So for the Dow Industrial Average, in the concluding 12 months, there was a core standouts led by financial services giants Goldman Sachs and J.P. Morgan Chase. You take a look up on your screen. Right now, I'm going to pull up our research on Goldman Sachs so you can see what our online research report looks like. Again, for those who may not be aware, here we go. So Goldman Sachs, if you're looking at on our screen right now, we have a timeliness of a 3, a safety of a 2, and a fund strength of an A++. So all in the spotlight in 2016 was a quartet of old-line industrial behemoths, Boeing, Chevron, Caterpillar, and DuPont. After leading the way higher in 2014 and 2015, the footwear Nike put up the rear in 2016. Coke also struggled. So if we take a look again on the screen, just take a look at Coca-Cola. But typing in KO, the ticker, and just clicking on the name of the company will the report. We can see right here we have a rank, a safety of a 1, timeliness of a 2. If you scroll down, you can see commentary and valuation on this. Right here in the middle, you can take a look at the sales, but ultimately what I want to do is show you the chart. So we add the chart onto the screen right here for Coca-Cola, and we bring it out. And let's look at the 1-year period. We'll see this is what Coca-Cola looked like over the 1-year period right here. So that said, unlike 2015, most of the 30 composite members saw their fortunes rise in 2016. As though a year ago, there were divergences among the averages. This was apparent within the Dow Group itself. Here, for example, there were a handful of outsized gainers. However, many more made just modest strides. So it was the major averages. Point the Dow soared to near 20,000 to an annual rise of 13.4%. Levels tabulated by the broader S&P 500 index, and still smaller increases were secured by the NASDAQ and the companion NASDAQ 100. So while we're looking here at the chart, we can just throw on some other comparisons. In this case, let's just throw the Dow Jones on there to see a comparison to the Dow Jones versus Coke, Dow Jones being the line in gray. Meanwhile, leading the way higher was a Russell 2000, the small cap benchmark, which was in the black by almost 20% after having trailed most of the key averages in 2015. Case for years now, there was a rationale for this divergence. Our leaders in 2016 was a core group of the basic material stocks and a sprinkling of industrials. As rebounding oil prices and the promise of better days for infrastructure gave boost to the old line names and the industrial-heavy 30 Dow stocks. Now, at the same time, some consumer equities, which had done comparatively well in 2015, faded in 2016, especially late in the year, as pricing issues and profit-taking exerted selective pressure. As the winners in 2014 and 2015 were the losers in 2016. A story for many stocks that had struggled earlier in the decade as some came to life in the latest year. In particular, those tied to the commodity cycle and national economy, as oil prices doubled from earlier in the year while many of the economies around the world stopped eroding. Close this down on your screen. I'm just going to go back to our dashboard. And this is from all the tools that we have, so we'll leave it here for a moment as we continue. So meanwhile, at the end of 2015, we had forecasts that the average price for the Dow Jones Industrial Average in 2016 would be 17,335. That should prove conservative, with the stock composite actually averaging a little over 17,925. Interest rates then, we had forecasts and the strong post-election rally, which lifted the Dow to a series of record-closing highs, proved a tough combination to beat. While the forecast figure reflected our earnings projection for the Dow, our estimates for that composite, and a sense, once again, that rates would remain historically low. The average price for the Dow as the current fell in 2016 was 17,927. That's 3% above our estimate of 17,335. Our target fell short of the mark. Even earnings came in below expectations. The main culprit was another annual shortfall in the energy sector. On the other hand, interest rates stayed near record lows. The Federal Reserve refrained from lifting its target federal funds rate again until mid-December. We would look for the Fed to be more aggressive in 2017. Meaning dividend growth for the Dow again topped our forecast. So here, let's just pull up some research on Exxon, since we just mentioned some of the oil industry. So let's take a look at the Exxon report as we continue up. So on your screen, you'll see here in a moment, and with a safety rank of a 1 and a timeliness rank of 2. Now, those hopefully are all familiar by now what our timeliness rank is, with the measure of performance over the next 6 to 12-month period. In this case, a 2 would indicate a buy situation, as would a 1. A 3 would represent a neutral situation, and a 4 or 5 would indicate more of a sell situation. Just a quick overview of that. Let's look ahead now to 2017. With a strong increase of 11.5% for Dow 30 earnings, as projected benefits from a further strengthening in the economy, a big comeback in the energy category should carry the day. Note, however, that our forecast doesn't incorporate at least 3 rate hikes from the Federal Reserve. So, with rates so low and the economy seemingly on the mend, this more aggressive rate tone should not prove disruptive. Meanwhile, our 2017 net earnings estimates reflect the probability that the economy will hold its own, and then some. I think of resiliency in housing, real spending, growth, and a rise in business investment. This upturn in spending on the infrastructure, however, might not be fully felt until late in 2017 or even 2018. Based on these rather benign assumptions, our forecast calls for Dow earnings of just over $1,190, and dividends of $510 in 2017. To place these metrics and allowing for the first appreciable rise in interest rates since before the recession, the average, but not necessarily the high price for the Dow in 2017 would be $18,550. The table shows a likely earnings increase of 11.5%, which would be a strong gain given the mature phase of the long business recovery and the likelihood of a notable rise in interest rates in the upcoming year. In all, this 30 stock index should enjoy a solid pickup in 2017 net. Let's note one thing here. Also, that after likely gaining 4.4% in 2016, even softness in the oil patch and a rare decline in profits at tech icon Apple, earnings at 28 of the 30 Dow components are expected to rise in 2017. Let's pull up our report on Apple here, since we just mentioned it, and take a look at it for Apple, and we can show you how we feel about Apple at the moment. You'll screen here, Apple right now is ranked a 2 for safety and timeliness of 3. Range on the stock right here of 150 to 205. As noted, our average projection for the Dow in 2017 is 18,550. 0.8% above the average 2016 price for the Dow, 17,927. but still as I feared, the WebEx platform lost its audio for a second, but we are back, so I apologize for that. So let's just jump back a little bit here. I'm going to go back to in 2017, as we noted, that we expected Dow's earnings to increase by 11.5%, this declined to 6.2%, and interest rates reflected a more aggressive Federal Reserve to be slightly higher by the end of 2017. Rise in rates coupled with the rather extended level of the market recently will most assuredly make it hard to sustain loan widening. P multiples in the new year. Such a mix of variables is the basis for an average Dow price in 2017 that is well off recent levels, with the latter at a record as we went to press. Given the projected average price of $18,550 next year, I would be selling for 15.6 times our earnings forecast of $1,191. A year ago, we had been estimating 2016 PE multiple of 14.9. 2017 estimated PE implies that the market is now richly capitalized, even with the relatively upbeat economic fundamentals now in place. Another note I'd like to point out, the band about the 18,550 Dow Industrials target allows for a wide variance in price during 2017. Specifically, our Dow model's target of 18,550 represents the midpoint of a wide projected range in which the average price of that composite is statistically likely to wind up in 2017. The 2017 is 23,185 on the high end, 18,840 on the low end. Let me read again. The 2017 on the Dow, 20,185 on the high end, 4,840 on the low end. Forecast for the 2019 to 2021 band, the Dow, is 21,100 to 26,400. Note on that on this chart that we looked at before with Coke, saw that the Dow had a nice increase towards the end of this year. So we keep in mind everything we've been talking about up to this point. Let's conclude. The conclusions. All of this up and balancing out the likelihood of succession of interest rate increases, a noted divergence in fiscal direction, a more vigorous domestic business backdrop, for somewhat higher inflation, and the rather extended valuations currently in place, all is that any future market gains will come with effort. Make the market vulnerable to a degree, especially if the generally favorable fundamentals now in place are not sustained. While we may see further gains in the year ahead, we still counsel caution. That concludes the prepared remarks on the forecast for 2017. What I will do is now go into this bonus stock recommendation pick. This was a pick prepared by our research department, and the company we're going to talk about is AES Corp. And screen here, I'm going to bring up AES Corp. And let's look at that, and then I'll go a little bit into what we think about this company. See on your screen here in a moment. Okay. AES Corp, a safety of a 3 and a timeliness of 1. In the next 6 to 12 month time frame, we're saying this is a buy. based on the models that we utilize. So the Value Line Research Department recommends that professional subscribers of ours take a look at AES Corp, which again is the ticker AES. The Arlington, Virginia headquartered corporation has 4 lines of business: contract power generation, competitive supply, utilities, and growth distribution. The company employs 21,000 individuals and has a market cap of almost $8 billion. Many other infrastructure-related stocks, AES did not receive a significant boost following the presidential election of Donald Trump. And these we view as a positive, since equity still possesses ample appreciation potential, and the company ought to benefit from increased infrastructure spending, which is a key initiative of the incoming administration. On note, more specifically, AES management has been focusing on exiting foreign markets and expanding its operations within the United States. Now, leads from divesting international plants are being used to make domestic facilities more efficient. This should help AES become more competitive, lead to additional business wins in the power generation market. For 2017, our per share estimate currently stands at $1.15, AES's most profitable year since 2013. Absent, the stock is trading around $12, or just 10.4 times our share net estimate for the year. This is well below the issue's historical average, as well as the multiple we project to 2019-2021 time frame. Also significantly lower than its industry average. All old AES appears to be undervalued at the current quotation. The equity possesses several other positive investment attributes. It is ranked favorably for the year ahead relative price performance by our timeliness system, offers wide 3 to 5 year appreciation potential, and it's a dividend yield of around 4%. So old, we think now is a good time for professional subscribers to consider AES stock for the short and long term. And here's the report on your screen. You can see the digital report is up there. Just to remind you, if we go up here, show you the good old-fashioned PDF report. Still looks the same as always is. And just a reminder, those names and those numbers here in bold on the right-hand side are proprietary estimates and projections. So that kind of wraps up our prepared remarks. I'm going to jump over here to the Q&A and see what questions we have out here looming. Here's a good one. All right, so question. Has the formula to create timeliness changed over time? So basically what I think this person is asking is, have we made any changes to our model, our proprietary model, over the 85 years we've been in business? Basically, the answer would be no. There has been obviously probably some minor tweaks along the way, but overall our proprietary model remains the same as it has been for a very long period of time. So proud to say that's performed very well. We do keep performance numbers on those, and it has done well. We've got time for one more question. Why are we no longer getting history of timeliness ranks, someone asks. So you can see the history of timeliness ranks in the past PDF reports. If you don't have access to those, contact us and we can show you how to get those. You can also see the prior rank versus the current one. If you go back a few years back, again, there is a way to do that by looking at past historical reports, but we do provide some of that as well in a tabular format. For the sake of time, I know I've taken up a lot of your time today. Again, I apologize for the brief audio disruption. I want to leave you on this note. If you get our website, valuelinepro.com, and contact us for anything, on the top right-hand corner here, it's questions and contact us. Simply click on that, go to contact us, and there's a brief little form to fill out with your name and information. Submit a question. We'll be happy to get back to you. You can call us directly here at the number that you see on the screen, or you can email us directly here at is@valuelinepro.com. Also want to ask those who are prospective customers, feel free to reach us to get a free trial of our research services. And if you're a current customer, also, if you're interested in adding on any services, feel free to contact us as well. So I want to thank you for your time. Again, I'm Jason Wiseberg, Executive Vice President here with Value Line. We appreciate your business and look forward to serving your needs going forward, and enjoy the rest of your day.